Hi there, my name is Jason Ayers, CEO of the Croft Financial Group and a member of the Investment Review Committee. On behalf of the committee, thank you for taking the time to watch our Portfolio Manager's Brief for June 2020. Well, both Canadian and U.S. stock markets spent most of May range-bound before pushing higher into the end of the month. Notably, the Nasdaq erased all its pandemic-related losses, marking an all-time high for the tech-heavy U.S. index. Meanwhile, labor reports continue to reflect significant job losses, and employment is at lows not seen in over 20 years. While the stock market is known to be forward-looking, it's hard not to wonder if stock prices have gotten a little ahead of the economic realities, or should I say uncertainties. After all, the headwinds cited in last month's Portfolio Manager's Brief remain in place, namely consideration for and potential severity of a second wave, likelihood of an effective vaccine this year and how long will it take to restore the economy, and whether fiscal and monetary stimulus can continue to support the millions of unemployed as Main Street struggles to get back to work. Since the 2008 recession, monetary stimulus in concert with a low interest rate environment have always been prime contributors to asset prices moving higher. And once again this year, the U.S. Federal Reserve has reaffirmed its support for this policy until at least 2022. This commitment in and of itself seems to have been sufficient to prop up share prices and encourage the participation of retail traders in record numbers, all of which helping to drive the recent upward momentum. Add to that the relative attractiveness of the yield on the S&P comparative to the bond market, as outlined in our latest CIO research update entitled Walls of Worry, and one can see the case for owning stocks. However, even with company valuations adjusting higher to a lower interest rate environment, attractive dividend yields, and many companies now better equipped to face the crisis, the previously mentioned headwinds remain in place. And in the first 2 weeks of June, we saw the first significant pause in the recent relief rally. And once again, as referenced in last month's Portfolio Manager's Brief, with stocks having recovered so much so quickly and valuations on the high side for many companies, even considering the low interest rates, a pullback on renewed concerns of a second wave and the associated profit-taking on the part of investors is not all that surprising. That said, given the amount of liquidity in the market and the support for stocks by both investors and the Feds, a W-shaped pattern may not necessarily be in the cards. However, the risk of a retracement of the current uptrend would not be unrealistic as investors react to pandemic-related headlines and the related economic data. Based on the significant possibility of a pullback, we continued to remain defensive through the month of May. While our defensive stance has resulted in a lag in performance of our enhanced mandates compared to the benchmarks in the short term, with U.S. markets testing new highs so soon after the crash, we determined last month was not the time to be aggressive. June has so far proved to be a bumpy month, and we plan to use any market weakness to continue to build positions in companies on our watch list while maintaining a level of defensiveness. Our approach also includes active profit-taking and continuing to use a variety of option strategies to help offset some downside risk and take advantage of any increased market volatility. As always, we'd like to encourage everyone to stay safe and healthy as restrictions ease and we take initial steps towards reopening the economy. And once again, on behalf of the Croft Financial Group, thanks for watching.